We wanted to share our year-end letter that we send to clients in video form as an alternative way for our clients to get the content, but also to share it with a wider audience. And in the letter, what we do is we talk about the second half of the year and what played into some of the market reaction in that second half. And you can't recap 2016 without including the most significant event of the year, which is the election. In our second quarter letter, we were talking about Brexit election results, which happened in Britain. We stated, considering what has happened in our primary elections, we all should have seen this coming. And we had two significant events, both the primary elections in the US and the Brexit vote, that should have given us a clue about the outcome of the US presidential election. The so-called experts and poll takers had all their predictions wrong. They said Hillary Clinton was to be elected the next president, and if by some chance Donald Trump did win, the stock market would crash. The night of the election, the stock market futures first plunged as returns favoring Trump came in, but rebounded when Trump's victory speech sounded much different than his campaign speeches. Now that sounds different, but let's move on here. The day after the election, the US stock market went up and continued in its upward trajectory ever since. So much so that it was referred to as the Trump rally. The S&P 500 ended the year up 12% when you include dividends. An interesting quote was said about the election results, and we lost a citation, but it said the media took Trump literally, not seriously, but Trump supporters took him seriously, not literally. However, presidential elections tend to be won or lost on the state of the economy and whether you can get your supporters to the polls. People tend to vote based on their pocketbook. You probably remember past election statements like, "Are you better off than you were 4 years ago?" Just as the bureaucracy of the European Union made the cost of being a member greater than the benefits for the average United Kingdom citizen, globalization has been great for our large US multinational companies, but the average American worker has been left behind. So wait a minute. Why has the stock market gone way up right after the election when nothing changed? There has been no fiscal stimulus, no reduction in regulations, and no tax changes. The financial markets are always looking forward. The negativism of the ugly election process has been replaced with optimism. Trump has stated that he is not going to be sending Hillary to jail, and most of the very public figures who spoke out against Trump have become much less public in their opinions. On December 14, when the leading tech company CEOs, most of whom openly opposed him, met with Trump, he started the meeting with this: "I am here to help you do well." Existing polls showed that of voters who made over $250,000, 43% voted for Clinton and 42% voted for Trump. A post-election survey of those same voters found 62% said Trump would be good for their investments, and they plan to invest savings from any tax reductions into the stock market. The University of Michigan's Consumer Sentiment Index hit a high in December that it hadn't seen in 12 years. And similarly, small business optimism has soared in December. The US stock market was definitely the place to be in 2016, particularly in the fourth quarter after the election results. International stocks were negative detractors of performance, generally speaking. The main reason that international investments did so poorly was because the value of the US dollar went up 7.2% in the fourth quarter alone. When we invest in international stocks, we convert our dollars into currencies of the countries where we are investing in. If those international currencies decline, in value compared to the US dollar, our investment goes down in value as well. While most bond portfolios did well for the year, they had a very difficult fourth quarter. The yield on US 10-year Treasury was at 1.5% at the end of the second quarter. At the end of the year, the rate was 2.5%. So interest rates went up about a full percentage over the course of 6 months alone. When interest rates go up, the value of your bond holdings go down. This is because no one would pay you the same for a bond yielding less than a bond they could buy now with a higher yield. So the price of your lower yielding bond must come down to reflect its lower interest rate. It appears the 30-plus year bull market in bonds, which is from lower yields and higher prices, may be over. We still believe it is wise to be invested globally and to own some bonds in a portfolio to keep the risk level of the portfolio acceptable for most investors. So people are wondering, is the stock market ahead of itself and are stock valuations high? We're reminded of when Ronald Reagan was declared the presidential winner. The stock market went up 8% only to decline 22% in his first year in office. The stock market always overshoots to the upside and to the downside. In any given year, odds of a positive return on the S&P 500 are about 72%. In 5 years, it goes to 90%, and 10 years, 95%. So the bias is clearly to the upside. And for long-term investors, the odds increase in your favor the longer your holding period. Thank you for watching our year-end video of our year-end letter.